For many in the banking sector, 2022's end cannot come soon enough. A year of upheaval was marked by sputtering capital markets, job losses, rampant inflation, the crypto meltdown, and rising interest rates. The Federal Reserve will play a major role in determining whether 2023 brings revival or more of the same. The likelihood of a recession in 2019 is high, as the central bank keeps raising borrowing costs, albeit at a slower rate, in an effort to control price pressures. The biggest banks in the nation are well positioned to weather a downturn, including one that further hurts the mortgage industry, even though that typically means credit quality will suffer. In fact, traditional banks might even experience some relief from their adversaries in the fintech sector as a result of the anticipated economic headwinds. The pressure on banks to fulfill their commitments to diversity and demonstrate their advancement by being more open about the demographics of their workforce will not abate. Here is a look at what the industry might anticipate for 2023. Big banks will be fine. Big banks are well positioned to weather what is anticipated to be a turbulent year, even with staff reductions and a potential recession. Todd Baker, a senior fellow at Columbia University's business school who specializes in banking and financial technology, said, "Their capital position is strong, their liquidity position is strong. As far as I can tell, they haven't overextended themselves in any loan or risk category." Rohit Chopra, director of the CFPB, stated that our nation's banking laws provide strong tools to ensure that insured depository institutions do not breach the public trust. In the coming year, he added, "We expect to work with our fellow regulators on whether and how to use them. Although capital levels are high, a recession would force lenders to set aside much more in reserves to cover bad loans, hurting their bottom line and possibly increasing the number of layoffs. Higher interest rates should also continue to boost banks' net interest income, which is the difference between the money they make from lending money and the money they give depositors. Other banks are still having trouble. According to Baker, mid-size lenders have less capacity to invest in technology and are much more sensitive to regional dynamics. Smaller lenders can only expand through acquisitions. Mortgage pain in 2022. Rising interest rates devastated the housing market and caused a sharp decline in the number of new mortgages. This trend is anticipated to continue into the following year, with TransUnion forecasting that there will be just over 4 million purchase originations in that time, which is about half of what there were in 2021. The second half of 2022, in my opinion, looks a lot like 2023, according to Rocketco's CEO Jay Farner, who made this statement in an interview. "You'll need to provide the client with value more along the lines of fintech. As lenders struggle with the weak mortgage market, they should concentrate on interacting with customers in other ways and providing a variety of banking services before customers even begin to look for a home," according to Farner, whose company is one of the biggest mortgage lenders in the nation. End of fintech tourism. The past few years have seen a rapid expansion of financial technology companies, thanks to venture capital investments and lower borrowing costs. As some of the fintech tourists, as London Club's Anuj Nair refers to them, leave the area, that is quickly changing. Senior Vice President and Financial Health Officer at London Club Nair wrote in an email, "Now we are seeing some of the tourists pull back or bow out completely. But those who are focused on this market will continue to succeed and grow. Just like with e-commerce in 2000 and 2001, even Nair's company hasn't been exempt. This year, shares of the fintech have fallen by about 65%. Nair advised preparing for acquisitions or closed businesses, as venture capital funding becomes less plentiful. He predicted that fintech companies would cut back on expenses and carefully monitor their burn rate in the current market. Profitability rather than growth will once again receive attention. Alternative investments are one potential direction for growth. Crypto regulation. Since FTX collapsed in prominent investigations into Sam Bankman Business Fried's operations, cryptocurrency is a sector that is ready for regulation. Senators from Kansas Republican Roger Marshall and Massachusetts Democrat Elizabeth Warren recently introduced legislation to control the industry. Financial regulators have already focused on the collapse and its effects. Gary Gensler, the chair of the Securities and Exchange Commission, stated on Thursday that the organization's tolerance for companies like digital asset exchanges and others that disregard its rules is running thin. According to Gensler in an interview, the runway is getting shorter to start abiding by the law and signing up with the organization. In this Wild West, The casinos are non-compliant intermediaries. The SEC chairman has argued that most tokens are really just unregistered securities trading on the blockchain for the past 15 months. He asserts that they must adhere to the strict trading and investment guidelines set forth by the organization. Culture. Finance executives vowed to work to improve racial equity in the wake of George Floyd's murder in 2020, not just in the US, but also in Wall Street offices, where there has historically been just one black person in the room, if any. The major banks will probably divulge demographic information about their staff in the coming year, which will show how they've fared in the post-Floyd era. There are indications that progress is choppy so far. Ana Duarte McCarthy, who oversaw diversity initiatives at Citigroup Incorporated and currently provides consultation on inclusion to businesses and nonprofits, emphasized the importance of transparency. What we will be able to do is determine whether the strategies, plans, and deliberate attention are effective in luring, elevating, and advancing black talent. Without the precise numbers, she claimed, it is impossible to determine what is and is not working. What is the proverb? What is measured is implemented. Investment banking revival. As they wait for the Fed's benchmark rate to reach its peak, some dealmakers believe 2023 will see a recovery from this year's slump. In order to de-risk and syndicate the hung loans clogging up investment banks' balance sheets, equity and debt risk must be priced appropriately. Once that top is reached, according to Saba Nazer, co-head of financial sponsors at Bank of America. According to Nazer, this will create capacity to underwrite new transactions. The outlook is becoming somewhat clearer. According to Jim Langston, co-head of U.S. mergers and acquisitions at Cleary Gottlieb Steen and Hamilton, even though nobody can predict what the Fed will do in the coming year, or where inflation and unemployment rates will end up, Langston stated, I believe there is a better picture of that. We predict that activity will increase over the coming year. The flow is blocked. 2022. Bloomberg.